There's been north of 40 countries that have brought their gold back from both the Bank of England and the New York Fed, which these were the two areas, the two venues that provided liquidity, Western rule of law, safety, and gave direct access to the LBMA and the Comex, the two fugazi, crooked, manipulated, and starting to show the issues of said manipulation through delivery requests. And I think they're like, yeah, maybe we should get while the getting is good. And we'll see how long it takes for them to return the gold this time. But quite frankly, I think they're late to doing this. And I think you would see more and more countries decide they would want to do the exact same thing. Quite frankly, I think anyone that would leave their gold at either place is silly and missing a bigger picture.
For decades, many nations chose to store their gold reserves in the United States, primarily at the Federal Reserve Bank of New York and in London, trusting these financial centers for their political stability and global financial infrastructure. This practice, especially prominent during and after World War II, was seen as a safeguard against domestic instability. However, that calculus is changing. Germany's gold repatriation campaign between 2013 and 2017 marked a turning point. Berlin retrieved a substantial portion of its reserves from New York and Paris, citing transparency and national sovereignty, while Italy has been more cautious. Mounting pressure from lawmakers and analysts suggests that sentiment may be shifting there as well. AndySchectman, CEO of Miles Franklin, notes that over 40 countries have already begun repatriating their gold from institutions such as the New York Fed and the Bank of England. Once revered for offering liquidity, the rule of law, and efficient trading access through the LBMA and Comex, these institutions are increasingly viewed with skepticism. Schectman highlights the growing distrust of paper markets, particularly Comex and LBMA, which he argues are dominated by a handful of major bullion banks. These banks, ranging from 4 to 8 in number, hold more than half of the short positions on Comex, enabling them to suppress prices artificially. In early 2023, these players held short positions totaling over 400 million ounces of silver, reflecting the significant market concentration. Gold and silver are being rapidly withdrawn from major exchanges as central banks and institutional investors increasingly opt for physical delivery over paper contracts. This growing demand for real metal is revealing a serious gap between the number of paper claims and the actual bullion available. As AndySchectman highlights, this tightening supply could spark more profound market instability and is driving a global shift away from paper-based systems toward direct ownership of physical gold and silver. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Italy and Germany are supposedly the second and third largest holders of gold in the world. And I think when you realize what Germany went through the first time, you're talking almost $250 billion worth combined, German and Italian gold. And why? Because it's a bigger symptom, it's a symptom of a bigger problem, lack of trust. And that's the issue here, is that this is a trust-based system. When it was backed by gold, you didn't have to trust as much as you could redeem it for gold. That was the promise. Always return your dollars at a fixed rate of $35 an ounce if you were a foreign government. Well, at the end of World War II, after Europe had been ravaged by 2 world wars, it made sense to leave their gold here with the U.S. They would give us their gold, which was a non-interest-bearing asset. We would pay them $35 per ounce. They could take that money, invest in our treasuries, earn a yield on it, and always exchange it back for $35 an ounce. That was a good system. The dollar was, in fact, as good as gold, and we had no inflation. And then we saw what happened since 1971. Gold was $35 an ounce at that point. It just touched $3,500 not too long ago. That's 100%. It's lost 99% of its value plus in my lifetime. I was born in 1970. Well, you add into it all of the issues regarding the current political environment, the lack of trust that was brought in, anointed in the seizing of $5 billion in Russian treasuries. It's not our job to be judge, jury, and executioner when you're talking about a global reserve currency and issuer. And the world doesn't trust us anymore, including our allies. G7 members, they don't trust us anymore. And that's exactly what this is all about. And you're right, there's been north of 40 countries that have brought their gold back from both the Bank of England and the New York Fed, which these were the two areas, the two venues that provided liquidity, Western rule of law, safety, and gave direct access to the LBMA and the Comex, the two fugazi, crooked, manipulated, and starting to show the issues of said manipulation through delivery requests. And I think they're like, yeah, maybe we should get while the getting is good. And we'll see how long it takes for them to return the gold this time. But quite frankly, I think they're late to doing this, and I think you would see more and more countries decide they would want to do the exact same thing. Quite frankly, I think anyone that would leave their gold at either place is silly and missing a bigger picture. Gold and silver disappearing from the exchanges, that's the physical liquidity upon which this entire house of cards is based. And if you're pulling the liquidity out because it's standing for delivery, that's a problem. What you see in many cases is what's called a short squeeze, where the traders do not have the ounces of gold that standing behind the contracts that they have. And so they have to rush to get it in order to cover. That represents a short squeeze. So it is the buying of the central banks. It is the buying of the sovereign wealth funds. It is the buying of the biggest money in the world, the sophisticated money in the world, who is able to accumulate and stand for delivery, that is affecting the price at that level. And yes, it is exacerbated by these moments of panic covering in an environment where we continue to see delivery requests. And that's something that I think people need to really understand, that this is something that never, ever happened before. David Jensen does an amazing job on Substack of explaining this. He talks about, look, the LBMA is trading 200 million ounces of gold per day and 3.43 billion ounces of silver with a B per day. That's almost 4 times global mine supply per day, annual global mine supply per day, standing behind somewhere in the neighborhood of, I don't know, under 200 million ounces. That is the float. I think it's much less than that right now. So you're talking 12 plus times the float. What you're witnessing right now is a desperate effort by the West, who has always been able to easily manipulate the price of gold and silver through levered contracts, because no one ever challenged them by standing for delivery. And that's really the difference. And these deliveries continue to happen across the globe. So yeah, I think this should be looked at as a very optimistic and hopeful development, where they have to expend that kind of effort to hold the price down, and yet it really didn't go down very much, didn't dip below 36, and if it did for a very, very short period of time, and here we are right back above it again. I wouldn't want to be as stupid and irresponsible as these banks are, having that kind of a short position in an environment where much of the world is challenging it through delivery. So yeah, it's to his question, I think a lot of it is short covering, but it's short covering because these players, whether it be central banks or sovereign wealth funds, are standing for delivery. That's what's different. I think you're beginning to see it. I think you're beginning to see, maybe this is part of the reason we're seeing so much in the way of deliveries to back these naked contracts, to have the physical. I think it just will be much harder for banks to continue to play this game where they're using unallocated paper derivatives, which will dramatically affect the balance sheet. And so, yeah, I think this is an environment where we could expect to see much higher prices after the Basel III, maybe not immediately, but what it ought to do is make it much more difficult for these players to continue to suppress the price with unallocated paper, especially if they're standing for delivery, and especially if it starts to really negatively affect their balance sheet. This will become a game, I think, where that kind of position is considered foolhardy. So yes, ultimately in the long run, I think it's one of these deals where we can't expect it to happen just like that the moment the switch is flipped, but I think it is a trend that we are seeing where these banks already, it appears as though they're realizing this in gold. We haven't seen them capitulate in silver yet, but I think that's coming. And quite frankly, to have these unallocated naked positions against the backdrop of global demand and global offtake is as stupid as a mud wall in a rainstorm. And I think it will have a dramatic effect. Maybe not all at once, maybe not at first, but over time, absolutely it will. The environment that the Hunt brothers tried to expose and exploit is exactly what you see right now. Far more contracts than bars backing it. And they bought up all the contracts and stood for delivery. They changed the rules. They being the exchange, which is owned by the banks, which will protect themselves. The difference is the LBMA is not an exchange. It's an over-the-counter exchange. There isn't a central clearing authority. It's peer-to-peer in essence. me versus you. And if it breaks, there's no one there to step in per se, unless they get all of the members to do it. Whereas on Comex, it's a different thing. It's a different animal. They can just, in essence, create a force majeure, shut it down, say no more deliveries, or do what they did in London when you saw the nickel problem. They just invalidate everything. We're getting to the point where that will happen, where whether it's outright default, it'll appear the exact same thing, and it will be settled in a manner where you would say, well, this was done to avoid a default. And, I think that if we wait for that moment to happen, you can see that they're doing all they can right now to keep that from happening. We get to that point, if the COMEX were to default, the entire precious metals complex breaks down. And I think that ultimately where you will see things change is you're beginning to see the development and the maturity of other exchanges in Dubai, in Shanghai. You'll see the BRICS development of the BRICS Metals Exchange. You'll see the Moscow Exchange. These exchanges now in Singapore, these exchanges that are coming up throughout Asia in particular, and the BRICS network, will be more of a cash and carry, reflective of real price settlement. And it's almost like these players are trying to exploit as much as they can through delivery using the Western system until the Western system breaks. And whether it breaks by outright delivery default on one of the two exchanges is debatable. But I think in essence, whether we get to that point and see it or just realize it was inevitable before they came in and stepped in to protect themselves and changed the rules, the way they did under the Hunt brothers, where they said you can be as short as you want, but only long a certain amount, like 1 million contracts or whatever it is. And then anything over that amount, they were forced to sell. And that's what drove the price down. Now that is manipulation of the exchange to protect itself and screwed the Hunt brothers. Well, something like that I would expect would happen before you'd see one of these big banks blow up. But in London, no, I think in London you could see a default by a very large institution, and there will be no one in there to step in to rescue. It's a fair question. I can't really answer it definitively, but simply to say it seems like we're getting closer and closer to that moment.
Russia and China have presented a significant proposal ahead of the 17th BRICS summit in July, introducing a new investment platform designed to accelerate economic growth among member nations, while directly challenging the Western-led financial system. Presidents Vladimir Putin and Xi Jinping jointly unveiled the plan, which focuses on expanding economic cooperation across the global south and moving further away from U.S. dollar dominance. The BRICS has already begun settling bilateral trade in national currencies, but the volume of such transactions is expected to increase sharply following the summit. During a recent conference co-hosted by the Embassy of Brazil and the Center for Global India Insights, Russian Ambassador Denis Alipov confirmed that the bloc is working on mechanisms to structure trade deals using local currencies. AndySchectman notes that the BRICS strategy goes beyond just local currency usage. It includes settling trade imbalances in gold through the M-Bridge platform. To support this de-dollarization framework, gold exchanges connected to the Shanghai Metals Exchange are being established across Asia, Africa, and South America. These institutions will enable countries to bypass the traditional global financial infrastructure, which has long been dominated by Western influence and the IMF. Let's get back to the interview.
Those entities alone, added onto the BRICS, equates to roughly 90% of human population, the majority of global GDP, the majority of global commodity production, refining, the majority of the manufacturing capacity on the globe. You have Vietnam, who is just fully applied. Of course, China and Vietnam being two of the main manufacturing hubs in the world. You have Indonesia, who has just fully been admitted in and massive stash of nickel and rare earth. You have Mexico, who is now saying that they want to be one of the 45 countries who want to attend the BRICS meetings. You are seeing a growing alliance. And so, yes, I think the biggest thing to take away from it is the admission by Lavrov that these countries will be able to use the BRICS settlement system, which is trading central bank digital currencies across the bridge technology, which is M-Bridge, without the interference of SWIFT, settling in gold. We are seeing more and more rumblings coming out of the Shanghai Metals Exchange to open up exchanges across the network, across Africa and Asia and South America, to where that they will be able to internationalize gold deliveries from the Shanghai Exchange. The idea being we trade our local currencies over the M-bridge, settle any imbalances in gold. Now, the pushback to many of these statements would have been the BRICS alliance is not big enough. Okay, fine. You add in all of these entities which are BRICS aligned. The Belt Road alone is 75% of human population, 50% of global GDP. You add in the Shanghai Cooperation Organization and the Eurasian Economic Union to this, on top of the Belt Road to the BRICS, and you are talking a massive, massive swath of human population, of global production, of commodities, of global manufacturing, of military might. And I think it's something that would be a huge mistake to underestimate, with the stated goal coming out of Brazil being to find a new settlement system that bypasses the dominance of the dollar and the SWIFT system. So to me, that is what I am looking to see, and that's a big one, a really, really big one. And you'll note that they're very keen in saying that this technology, this BRICS technology, the bridge, M-bridge technology, is not compatible at dollars, pounds, and euro. So you're pigeonholing the West, and you are opening this up to the majority of the nations around the globe that are underdeveloped, that are resource rich, and that are looking to find a way not only to improve their standard of living, but to do so in an environment that perhaps is one that is more about cooperation rather than coercion, and converting to a dollar that has been very strong has been very difficult for these nations. As far as the Japanese carry trade is concerned, yeah, I mean, I'm surprised we haven't seen more fallout from it yet, but this is a situation that is unwinding. Of course, the whole premise of the carry trade was that institutions or countries or people could invest, buy or borrow in Japanese yen at next to nothing, at zero rates, and then convert to dollars and buy dollar-based assets, whether it be cryptocurrencies, whether it be Nvidia stock or Apple, whether it be treasuries. And that's unwinding as the yen goes higher and the rates go higher. That remains to be seen how that all plays out. And even the wild card, do they actually entertain joining BRICS, as people like Jim Willey have thought perhaps is in the cards? So there's a lot of fluidity. Then again, the difference between this administration and last is the last administration, their actions were too stupid to be stupid. This administration, their actions are more subtle and maybe even a little bit more confrontational, but all leading to the same thing, and that is an increase in de-dollarization, an increase in unification by these countries, safety in numbers. And I think when you look at what's happened with Iran, and some people might think, well, maybe it's a little bit more than meets the eye. Maybe this is a shot across the bow with the BRICS, as in fact they are full BRICS members and are full Shanghai Cooperation Organization members. This will not be something easy, and I think these nations understand. You look at India, you look at Saudi Arabia, who seem to be straddling a little bit both sides. That's understandable. Until everything is set and everything is unified, this will be a slow-moving, yet developing event. And I think people need to not focus too much on the immediacy of something like the BRICS meeting, but look at the pieces that continue to be put together. And as far as I'm concerned, this has not stopped. In fact, this is the biggest piece of BRICS bullish news that I've heard in the 4 years I've been covering it, and that is that they have the ability to offer this network to non-BRICS nations, with the exception of the euro, the pound, and the dollar. I think that is a massive shot back across the Western bow, and something I'm looking forward to see unfold over the next few weeks as that meeting starts here in the first week of July. Vince Lancia said it's like two drunk guys holding each other up. You have, one broke nation buying the debt of another broke nation, and it's silly when you think that. And if you really do believe that a country as small as the Cayman Islands is using over 15% of their entire national budget to buy our treasuries, I have a bridge to sell you. And that's why, again, I bring up Jim Willey again, and his take is that the Federal Reserve is paying under the table to these countries to buy our treasuries. Now, could it be? I mean, it's certainly plausible, because who in their right mind would buy a treasury from the United States of any duration right now at 4% interest rate or so on a 10-year treasury is just silly. in an environment where inflation is absolutely kneecapping that. And this is why you get the lies coming out of the CPI or out of the Bureau of Labor Statistics, namely the CPI, which tell us that inflation is under control, yet it's a different number than my grocery bill is telling me, than the restaurant bill is telling me, than the tuition bill is telling me, than the insurance bill is telling me. But I thought that inflation was under control. Well, no, I think it's a stated goal of the Bureau of Labor Statistics to not be honest with us for reasons such as this. And you can see President Trump certainly would like to see rates go lower, because we have somewhere in the neighborhood of, I don't know, $9 trillion in debt that needs to be refinanced here over the next several months at rates that make it that much tougher. So, look, I just think that this is something that will have great fluidity, and I would certainly not underestimate the significance of what Sergei Lavrov has said by opening up this payment system to countries that are not BRICS nations, because they have an awful lot of nations that are aligned ideologically and other ways with China, with the BRICS, and this is a way to, I think, really, really accelerate the development of alternative payment systems to the dollar.
If the investment platform gains consensus among member states, it could reshape global capital flows. By offering alternatives to IMF and World Bank financing, the platform would allow developing nations to seek support outside the dollar-centric system. Schectman points out that critics once dismissed BRICS as inconsequential, but with new partnerships and expanded coordination, the bloc now holds considerable weight in both economic and demographic terms. BRICS members Russia and China will push for trade in national currencies in the upcoming 2025 summit. The development would benefit other member nations, as their local currencies will be traded for goods and commodities. From oil payments to grains and hardware imports, skipping the US dollar for settlements will boost their GDP. Beneath the surface of global finance, a quiet revolution is accelerating. As nations pull their reserves from traditional vaults and form new financial coalitions, the symbolic and strategic value of hard assets is being redefined. As centralized exchanges and long-standing alliances face growing scrutiny, the architecture of global trade may soon look radically different. Is the world witnessing the twilight of legacy financial institutions or the dawn of a decentralized gold-backed order? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.